For as long as traders have stared at charts, one question has divided the markets like a fault line running through time. Which side truly wins in Forex, fundamental analysis or technical analysis? It's the debate that defines every trader's journey. One side studies economics, interest rates, and central banks. The other side reads candles, momentum, and patterns. Both claim victory. Both swear the other is blind. But the truth lies somewhere in the war between logic and rhythm. Every trader starts somewhere. Some chase headlines, believing tomorrow's inflation data holds the key. Others chase price action, believing everything is already in the chart. Both are right and both are wrong, because the market rewards not who believes, but who adapts. Fundamental analysis is the language of the global economy. It looks beneath the surface: GDP, unemployment, inflation, trade balances, government policy. It's the heartbeat of nations, pulsing through every currency pair. It tells you why prices should move. Technical analysis, on the other hand, is the language of the crowd. It listens to what traders are doing right now. Candles, moving averages, RSI, trend lines. These are footprints of emotion and fear. They don't care about tomorrow's GDP. They care about what happens in the next tick. So which wins? The answer depends on time. In the world of scalpers, where seconds decide profit or loss, fundamentals are too slow. The news has already hit the chart before you can blink. Here, technicals reign supreme: the quick, the precise, the ruthless. Scalpers survive by reading rhythm, not reports. Day traders live slightly longer, hours, maybe a full session. They surf volatility, use chart patterns, and sometimes glance at the calendar for big economic events. They don't need to know the future of the Eurozone. They just need to catch today's move before it fades. Then come the swing traders. They hold positions for days or weeks. For them, the market becomes a chessboard. They use fundamentals to set the board and technicals to make the moves. They know a currency can't rise forever without economic muscle behind it. They blend both worlds because time finally allows both to speak. And beyond them, the position traders. The patient ones. The long-view thinkers who don't flinch when candles dance. These traders live in the realm of fundamentals. They watch central banks, budget balances, trade flows, and bond yields. To them, a rate hike is worth more than 1,000 candlesticks. They bet on nations, not noise. Across every horizon, the balance shifts. The shorter the trade, the louder the chart. The longer the trade, the louder the economy. Now step back and look at the global picture. Major currency pairs like euro to US dollar or US dollar to Japanese yen are oceans of liquidity. Patterns form, break, reform. Technical signals echo because millions see the same levels. Support becomes prophecy. Resistance becomes myth. Here, technicals thrive. But in exotic waters, USD/TRY, USD/AR, volatility erupts like storms. Political chaos, central bank intervention, and liquidity gaps tear charts apart. Here, fundamentals take control. A single policy announcement can move prices more than any pattern ever could. And behind it all stand two armies of traders: institutions and retail. Institutional traders, hedge funds, banks, asset managers, have teams of economists dissecting every policy statement. They build models, project yield curves, and run simulations. Yet, they still glance at the charts before pulling the trigger. They know timing is everything. Fundamentals tell them what to buy. Technicals tell them when. Retail traders, trading from their laptops at midnight, often have no access to those research terminals. They rely on what's visible: charts, indicators, price action. It's simpler, faster, and feels controllable. But even they know that when the Fed speaks, the candles obey. Both worlds collide, one with data, one with instinct. And both can win if they understand the other. In calm markets, trends stretch like highways. Technical traders flourish. They follow momentum, let profits run, and ride the wave of crowd psychology. But when the world shakes, when crises erupt or central banks intervene, fundamentals grab the wheel. Policy, politics, and panic rewrite the rules in seconds. There are times when charts look perfect, yet fundamentals shift beneath them. Interest rate changes, trade deficits, inflation surprises, they can turn a bullish chart into a trap. The trader who ignored the data gets crushed. And then there are times when fundamentals say one thing, but charts scream another. The economy looks strong, yet price keeps falling. That's the market whispering, something's wrong. Price often knows before people do. Across decades of research, surveys of dealers, and thousands of backtests, the story repeats. Short-term profits often come from technicals, but long-term conviction comes from fundamentals. The best traders don't pick sides, they build bridges. Imagine it like flying a plane. Fundamentals are the map, they show you where the destination lies. Technicals are the instruments, they tell you when to climb, when to descend, when to bank left. Fly with one, and you might survive. Fly with both, and you can navigate any storm. Many traders learn this lesson the hard way. Some build perfect models, predicting central bank decisions, yet lose money because they entered too early. Others ride perfect chart patterns, yet miss the bigger picture and get blindsided by policy shocks. Markets punish arrogance and reward integration. Hybrid strategies, that's where the magic happens. Traders who combine both worlds tend to stay longer in the game. They use macro trends to set the direction, technical signals to execute with precision, and risk management to survive the noise. It's not about predicting. It's about aligning probability with discipline. Every institutional desk knows this. They might start the week bullish on the dollar because inflation is rising and rates are high, that's fundamentals. But they'll wait for a technical breakout to confirm it. When both align, conviction skyrockets. That's when the big money moves. And yet, this truth is older than the charts themselves. The Bank of England once surveyed hundreds of Forex dealers. 90% used chart analysis for short-term trading. 85% relied on fundamentals for long-term positioning. Nearly all admitted the real edge comes from using both. Why? Because markets are human. Humans create patterns, but they also create policy. One speaks through charts, the other through decisions. Even in the age of algorithms, this balance remains. Quant funds may crunch billions of data points, but they still build their systems on the same twin pillars, momentum and macro. Machines have simply learned to read both faster. So which analysis truly wins? Neither and both. Technical analysis wins the battles. Fundamental analysis wins the war. Technicals let you surf the waves of emotion. Fundamentals help you understand the tide. Technicals bring precision, fundamentals bring perspective. One without the other is like driving at full speed with your headlights off. In reality, the trader who thrives is not the one who worships a method, it's the one who evolves. The one who knows when to listen to data and when to listen to the chart. The one who sees patterns in both numbers and narratives. And that's the real secret. Forex isn't a science of certainty. It's an art of probability. Fundamentals show you value. Technicals show you timing. Combine them, and you find conviction. Ignore one, and you trade blind. When markets trend, the technicians lead the parade. When economies shift, the fundamentalists call the turn. But the true professionals, the ones who last, know how to read both rhythms. They treat the market like a living organism, part logic, part emotion, part chaos. That's why every trader's evolution follows the same path. At first, it's all charts. Then it's all news. And eventually, it's balance. Because mastery isn't choosing sides. It's knowing how to unite them. When fundamentals and technicals align, trades feel effortless. The chart confirms the story. The data confirms the chart. That's when traders say it feels like the market is speaking clearly. Those moments don't happen often, but when they do, they define careers. Look at any great trade in history. The yen carry trade, the dollar bull run, the euro debt crisis. Each was born from fundamentals but executed through technicals. That combination, that synergy, is what separates professionals from hopefuls. So, to every trader watching, stop searching for the one true method. There isn't one. The greatest traders are translators. They translate between the language of economies and the rhythm of price. In a market that never sleeps, the battle between fundamental and technical will never end. But the winners, they stopped fighting long ago. They learned to listen to both sides of the story. Because the market doesn't care what you believe. It only cares if you understand.